Welcome, everybody. Glad to be here. I'm a professor at Columbia Business School. I do a lot of work on financial intermediation, banking, fintech, and real estate. And recently, along with my colleagues, I've done quite a lot of work on financial stability and drawing lessons from the recent bank failures, such as the Silicon Valley Bank. I would like to tell you a little bit about. So let me tell you our view. What we think is one of the main sources of risk currently in the US financial system. From our perspective, it's really the fact that banks have very high leverage. If you look on a typical bank in the United States, and there is really very little variation, whether you're a small bank, whether you're a large bank, banks are essentially about 90% debt funded, and only 10% of equity. So think about what it means. Consider, for example, a situation when there is a modest decline in the value of bank assets, let's say 10%. That already potentially put these institutions at the brink of insolvency, because the value of the assets will be less than the face value of the liabilities. And if you look on the banking sector as a whole, you know, this is a $24 trillion of assets. On the asset side, banks take a lot of duration risk and credit risk. They give a lot of assets like securities, long-term treasuries, long-term mortgage-backed securities. In addition, they have real estate loans, including commercial real estate loans, and other loans like corporate loans with a credit risk. And the way they finance it is essentially with short-term debt. Most of these debts are deposits, about 18 trillion of them, and about half are insured by FDIC and half are uninsured. These are deposits above $250,000. And in addition to that, the banks have fairly thin equity cushion. So you can see this is a pretty fragile system with very little equity financing and a lot of debt financing. And in that sense, the recent monetary tightening illustrates this point. The Fed raised interest rates very aggressively. Essentially, in a matter of a year, they went from 0 to 5%. What it means to the value of long-duration assets, there has been a very big decline in the value, including US Treasuries and so on. If you look on long-duration assets, long-term bonds, they decline by, in the order of 30%. So when you take this decline, the market-implied decline in the value of assets, and apply it to bank balance sheets, what you will find is that in the aggregate, the value of the bank assets right now is about $2 trillion less relative to where it was at the beginning of the Fed tightening cycle. And in fact, there's quite a few banks in the US right now, and Silicon Valley Bank was one of them, that currently have the value of the assets, the market value, being less than the face value of the debt. So in principle, if the depositors would show up, this bank would fail, unless, of course, regulators step in. Now, I'm not trying to say that all these banks will fail. It depends on your funding, and in particular, it depends what portion of your funding is unstable, especially uninsured deposits, because uninsured depositors can lose money if the bank fails. And in that sense, the Silicon Valley Bank was an outlier, that 80% of its assets were financed with uninsured deposits. Essentially, Silicon Valley Bank had just uninsured deposit funding, so it's very fragile in that sense. And the question is, and the mechanism is as follows, the interest rates go up, you can add to this credit risk, bank asset values decline like they did, uninsured depositors get spooked, they see these big declines in asset values, they worry about solvency of the bank, they start withdrawing money, and then you can end up with a run equilibrium. The key question, and I was talking a lot with regulators about that, is how special is a Silicon Valley Bank? Are there other banks like that? And the short answer is yes. There's quite a few banks in the United States right now that have very similar risk characteristics. Not as extreme as Silicon Valley Bank, but you can support a run on them. They are actually at the risk of run. And this is just the duration effect. If you add to this credit risk, remember that for a mid-sized banks, about 25 to 30% of the assets are commercial real estate loans. We did analysis loan by loan. 14% of these loans are underwater, meaning the property value is worth less currently than the face value of debt. If you look on office loans, it's 44%. So in addition to this duration risk, there is also a credit risk that will enlarge the set of banks that could potentially fail. So the obvious question is, and talking all the time with regulators, what to do about it. And one natural answer is, well, let's raise the bank capital requirements. Maybe not right now. Once the things come down a bit, that would make the system more safe. But the obvious question is how much leverage financial institutions really need to provide efficient functions like originating loans and doing other things. And in fact, we have a window in it. We compare the leverage of banks to non-bank lenders. The black curve shows you the non-bank lenders. These are the institutions that make loans like banks. This is in the mortgage market, but don't have access to insured deposit funding and are lightly regulated. And guess what? In this private market benchmark, without access to insured deposit funding, these institutions have much less leverage and much more equity funding. And the lesson we draw from this, you can be a pretty good lender with much lower leverage. And what's interesting is the biggest discrepancy is actually for smaller and mid-sized banks. What it means is, let's say the JP Morgan, their leverage is pretty close to what they would have been levered even if they wouldn't have access to insured deposit funding. It's precisely the smaller and mid-sized banks, including banks like Silicon Valley Bank, that were levered much more, and because of this implicit and explicit guarantees. You know, Silicon Valley Bank did not have much insured deposit funding, but there's a lot of other banks that do and take advantage of that. One, of course, thing is that, you know, if you talk to bank CEOs, they will tell you, hey, if you raise bank capital requirements, the lending will collapse. And we're going to have contraction of economic activity. We just really cannot do it. Of course, the answer to this question depends on how important are banks in financing credit to households and firms. And let me just tell you, they are not as important as commonly thought. In the 1970s, bank balance sheet financed 60% of lending to households and firms. So in other words, in the 1970s, banks were very important. Nowadays, bank finance only about a third of credit to households and firms. The rest is financed through debt securities, private credit, and so on and so forth. So in the aggregate, the banks are much less important than they were a few decades ago. And what it means, it has interesting implication for capital regulation. What would happen, we actually did a simulation, if you would raise capital requirements on US banks, well, the amount of bank balance sheet lending will drop substantially, and so is the bank profits. So, you know, it's kind of understandable why some bank CEOs might not like it, but the aggregate decline in lending would actually be quite modest. What would simply happen, bank would still make loans, but instead of keeping them on balance sheet, they would sell them, and there would be expansion of non-bank and private credit. So let me just conclude with some thoughts where I'm thinking it will go going forward. First, I think the banks are continue to become increasingly less relevant, and especially smaller and mid-sized banks. We have ongoing consolidation in the banking industry. I predict in a few years we'll have much fewer smaller and mid-sized banks. I also think that we'll see a growing rise of debt securities and private credit. Private credit is rapidly increasing right now. And of course, who's going to finance a lot of that? You know, vehicles like money market funds, exchange-traded funds, and so on. On the asset side, the traditional banks already lost a lot of edge. Think about the mortgage finance, which is a very important debt market. Now banks account for less than half of the lending there, and the biggest lender is Quicken Loan. No, Quicken Loan is currently called Rocket Mortgage. You know, they just have, you know, the platform. They don't have deposits. It's a non-bank. And, you know, impact of AI is likely to make things potentially worse for banks. As we just heard a little bit in an earlier session, I expect these non-bank financial institutions to possibly be more able to innovate in this space, especially because they are more lightly regulated. And so essentially, the main value the banks currently derive is on the liability side. Is this access to insured deposit funding allows them this cheap debt they can recycle into loans, but also in securities and other vehicles. So in some ways, survival of especially mid-size and smaller banks critically depends on continued access to these implicit and explicit subsidies. And if the regulators decide to crack it down, we'll see further contraction of smaller and mid-sized banks. Bigger banks, of course, will have to innovate harder and harder to stay relevant, but they have a scale, so they probably will be able to continue operating. And the last thing, even on the liability side, there are many innovations that threaten banks. Think about central bank digital currency or alternative payment systems. If this takes the deposit role from the banks, they'll be really in a precarious state because, you know, on the asset side, it's already very difficult for them to make money. Once they lose these deposit advantages, it will be a difficult position for them. So thank you very much, and thanks for your attention.